And welcome to Recovery Report Live. I'm Dan Odess, president of GlobalPro, where we manage risk to recovery, and we have managed more than $1 billion in recovery for both community associations and business owners for a decade. We are celebrating our 10th year in business, headquartered out of Miami, Florida, but have offices strategically placed throughout this country, particularly in the Northeast and New York, as well as Dallas, Texas. We serve the policyholders' interest day in, day out, and we continue to advocate for your rights as policyholders. I say all of that as a lead up into today's show for a really specific reason, because there's a difference between what we know versus what they want us to believe. All right, and that's the title of today's show, is what we know versus what they want us to believe. And when I say they, I mean insurance companies, the insurance industry. And I'm going to get a little technical today about what's happening right now as we hear about the earnings for these businesses, these corporations, many of them international, some of them domestic. And the earnings that we are learning of, that we are reviewing and reading and gathering information about and getting a better understanding of, are showing us quite a few things about the messaging to their shareholders versus the messaging to the consumer, the policyholder that is paying them their hard-earned money, their premiums in exchange for a product. And I'm not only talking about community association business owners, I'm talking about homeowners alike. You are paying a premium in exchange for a promise, two things actually, the fiduciary obligation as well as indemnification, right? The promise and the action of actually paying and restoring you to a pre-loss condition financially. And the messaging right now couldn't be any more confusing. There is a massive difference between what we know versus what they want us to believe. And I'm going to target what we know first, right? So what we know is that the industry, and I'm gonna get a little granular here. I got some statistics in front of me. I'm gonna get a little fancy with this messaging, right? So I'm gonna give it the industry. Let's do the industry. Let's go big, and I'm gonna actually give you a specific example, right? So the industry is up 5.2%. 5.2%. This means the industry has gained 5.4% over the past year, okay? As for the next few years, earnings are expected to grow by 18% per year, all right? So 5.2 as of last week, meaning over the last year, 5.4% up, and it's expected to grow by 18%, right? So now, one of these insurers is actually reporting profit that came in at $3.39 billion, all right? And they have both exposure on property and casualty as well as life business, okay, are outperforming their other lines of insurance, right? So I highlight this and emphasize this issue for this industry, and it was important to me that I actually saw property casualty mentioned in that sentence, that it's outperforming, that there's this tremendous amount of profit. Because we're being led to believe by a lot of insurance brokers and insurance companies alike, and the brokers are mostly peddling the information that they're getting from the insurance company when they're left with allegedly one option. And I can say this having a business that focuses in insurance, primarily it's advocacy for policyholders, and that operates in numerous different markets. And this just isn't about Florida or particularly South Florida. Obviously, we're headquartered in the Miami area, but we operate throughout the state of Florida. In fact, we have a satellite office in Orlando area, as well as we've had them in the Panhandle area, helping to provide services to our policyholders that have suffered loss and damage. Now, so I have a broad view of this as an insurance expert in handling thousands of claims for policyholders, having reviewed thousands of policies, and more often today than ever before, helping our clients place insurance. And in fact, we're actually getting phone calls now today to actually help place insurance, more so than even actually helping with recovering a loss. And it's the season for it, and things will change. And as these storms kick up, the things will kind of shift back to business as usual. But I don't think the desire to have a third-party consultant representing someone's interest, placing insurance, is ever going to go away again. And the reason for it is because these insurance companies every year continue to get away with these issues, right? They continue to provide this idea, this take that we're in a hard market, a hard insurance market. They're treating it as a hard market, but the reality of it is, if you get granular with it and you look at it, it's that their investments, okay, their investments may not be performing as expected. So when they're saying that it's been a tough quarter or whatever it is, if you get into it, their profits on the product they're selling are in most instances outperforming other segments or other industries. And in fact, they're absolutely crushing it. They're crushing it. They're making more money than they've ever made. I know, talking with some brokers that I'm very friendly with, off record, obviously can't state names, and I wouldn't for the sanctity of what they're doing and everything else, and because I care about them. But the reality of it is that they're making more money today than they probably ever has, because most people don't negotiate the commissions that are being paid to their brokers, and if they don't negotiate now, as the price goes up and the product, the actual coverage goes down, and they continue to pay more for less coverage, well, the broker's just making more money selling you less insurance, right? So they're making more money today than ever before because prices are super high in most markets throughout the country. I would say almost nearly all of them. And the reality of it is that's mostly predicated on changes in the market. It has nothing to really do with your loss history, despite the fact that that's another misnomer that's often peddled by a lot of brokers and insurance companies. Oh, the losses, the losses, the losses. Well, here I have it. Here I have it. Reported earnings, huge billions in profits. Now, of course, economically, there's been some shifts in supply chain issues. I mean, one of the largest investors in real estate in the world are insurance companies. So if the real estate market starts to struggle and the earnings for those real estate investments or those other investments the insurance companies are making, right, through other vehicles and investment vehicles and et cetera, then maybe they're just not making as much money on your money. But that doesn't mean they haven't made money on your money, right? They've already made the product, they already made the profit on the product they sold you. But they're trying to take the woes and the losses of their investments, their potentially poor investment strategy, those losses, and then spin it and then pass off that loss to you, driving up the cost of insurance in some instances, right? So, I mean, there's no other way of looking at it. Again, I've done this before. I challenge anyone to come on the show any day of the week. I'll do it recorded, I'll do it live, doesn't matter, to talk about these things and to challenge me on these issues, and bring facts, though, with you. Because when I'm looking at these facts and this information that's publicly available, but interestingly enough, typically very difficult to find and to correlate and to put together and to connect all the dots on. But when I look at these things and I drill down on these issues and I look at what's going on today, and I'm looking at an incredibly rich industry, and then I think about what we were just talking about last week, right? We had on a law firm that we were talking about satisfaction amongst consumers and the absolute mega rise in dissatisfaction amongst policyholders. And then I think about the lobbying efforts to extend the period of time for an insurance company to pay a claim. Meaning that's the one time that they're gonna have to actually give you money, not give money to a real estate developer or an asset manager to make them more money on your money, but to actually pay you based on your contract. There is a growing amount of hugely unsatisfied consumers that in the infancy of their claims, they're dissatisfied with the communication and the handling of their loss and damage. The compassion that insurance companies are showing to consumers is at an all-time low. It goes without saying. There are too many consumer reports that are clearly demonstrating, showing it. It's also showing the total and complete irrelevance of financial reporting on these insurance companies, because if you actually look at the profits they're making from what they're selling you, they are making money, but it's what they're investing this money in. It almost begs the question as to why are they even investing in these things if they're making so much money already on the products they're selling you, and why aren't they just simply holding onto the cash or reserving it, or maybe making less aggressive investments, taking less risk to make sure they have the money to pay you. And it maybe if they just provided you better service, maybe that word would get out and more consumers would run to them to buy their insurance and even pay more for it, making them even more profitable. But that would require them to not get too greedy with the money they have already taken from you and the strategy in which they're deploying in order to make money on that money to continue to report record profits and obviously pay their actual policyholder rather than their stockholder, right? So if you're more focused on the person holding your stock versus your policyholder, the consumer that actually paid for the product, and I think that's probably some of the issue right now in the corporate world, and the desire to make profit seems to be one of the biggest challenges I think facing insurance companies. If there's billions of dollars being poured into insurtech, and the insurtech industry at large is reporting a lack of adoption or the lack of interest in adopting their products, and it is the insurtech CEOs and strategists reporting this. It's not me. It's just literally I'm reading the reports themselves. Every week there's another one saying the same thing, and every week it's the same old story, and every quarter it's the same thing that we typically see here, right? And the reality of it is that a lot of the reports from the insurtech industry, as we mentioned on prior broadcast, talks about how through adoption of their technology, they can expedite the process. There would be a lot more clarity to the situation. There would be and allegedly it would lead to less disputes. Now, disputes are the reasons why they want further anti-consumer legislation, despite the fact that in this last session, particularly in Florida, they didn't even report on actual dollars. They just use volume of lawsuits, not the actual meaningful dollars behind them to justify it, meaning while there may be a rise in lawsuits, it doesn't mean that there was a rise in claim values. It's not one and the same. But there's this insinuation that it may be, and that's what's maybe leading to their losses. But even the legislation that passed, which cut out all these consumers' access or made it more difficult or costly access to the courts, the people that even peddled this idea, this legislative changes, was stripped, stripped the obligation of the insurers to commit to their promise, okay? It stripped more of it out. We're finding ourselves in a situation that, quite frankly, is just more and more becoming untenable. Which brings me to my last point of today's broadcast, which is that you're buying, if you're a commercial property owner operator or you're a condominium association, when you buy insurance, I want you to think about buying insurance based on sublimits and not on limits themselves, okay? And what I mean by that is that most claims are being actually handled or adjusted based on a sublimit and not the limits of the policy. Rarely, if ever, do you see the limits of a policy for commercial property or a condominium association, homeowner association as well. Any of these large policies, a commercial policy form, come into play or have any real bearing on the claims themselves. Now, it is important for compliance with your lien holders, your mortgage company, but when it comes to the actual claims themselves, most of our adjustments are limited or impacted by a sublimit. Sublimits are becoming more important than the limits themselves. I truly mean it. And I wish a lot of the banks would wake up to this and realize that, quite frankly, the $500,000 policy that Sally bought, for her home, actually, in most instances, is not going to pay $500,000 for any sort of loss she has. In fact, most claims that she experiences in her property today is probably going to be subject to some sort of significant limit or higher deductible, which is going to require Sally to come out of pocket way more money than she's ever in history had to do, meaning that it's going to put further financial strain on her. And the whole purpose of the insurance policy to begin with was to protect you, the bank, from having a financial issue with your borrower, right? You want to make sure the borrower has money tomorrow and is not in a financial situation that they cannot make good on their promise to you in your contract to pay their mortgage payments. So, again, not a lot of banks are waking up to this. In fact, a lot of the banks are involved in the insurance industry or largely own some of your bigger insurance agencies that are selling a lot of the products and are trying to justify huge rate increases. But I would argue with the idea that we're in a hard market right now. I truly, truly have a hard time with it. Yes, I understand the costs of construction are going up. Yes, I understand that there's supply chain issues. But here's the funny thing, it's actually sad. It's not really funny. The sad thing is that I have two situations claims that just came to us where insurance companies are enforcing 180 in one instance and a 365-day limitation on an insured's ability to recover actual cash value, the depreciation on that actual cash value loss and to recovery, despite the fact that they paid replacement cost value for the policy. They have a replacement cost value policy. Let me say it this way. They have a replacement cost value policy that they paid for, and there's a provision in the policy that allows the insurance company to subject them to a limitation on the recovery if the construction is not completed for and the claim is not made for that depreciation and can't be paid back, right, within a specified period of time. One insurance company actually took the position that they weren't put on quote-unquote notice that the insured was making a replacement cost value claim. Strangest argument. I mean, just totally doesn't make any sense. But the reality is that these insurance companies are fully aware that there are supply chain issues, that there are increased costs in construction, but they don't care. They're actually not granting extensions to these commercial property owners to allow them to continue to submit their incurred expenses to recover the additional money, even though, by the way, let's not even get into the fact that the application of the depreciation was so egregious. In one instance, it was more than 50%. Now, and this was a building constructed in the the early 2000s. And there's more than 50% depreciation taken on just right across the board on everything, including the profit and overhead, general conditions. It was crazy. They held back on tax. They held back on the tax for the project. They depreciated and took a deduction on overhead and profit. They took a deduction on general conditions. I mean, it took a deduction on permits. They took a deduction on all these things. I think we've just completely missed the idea of what the purpose of depreciation is in the first place. And it makes no sense. It does not make any sense. So there's a lot to unpack there and a lot to pull apart and to explain to you. But my point I'm trying to make here today on this broadcast, and we'll get into depreciation again. We had done it a couple times before, but I think now's the opportunity to do it because of these cases that just came in. But I want to get in the weeds on those claims a little bit and hear the insurance company out a little bit and report back to you all as to how the insurance companies are going to be handling this issue and what you should be looking for, what some of the pitfalls. But here's the thing, which I don't understand, is that they complain about the hard market situation. They acknowledge it, but when they're charging you for the insurance, but when they owe you the money, they don't want to take into consideration and pay you the money that they would otherwise owe you. I mean, do you get it? Do you hear me yet? Do you understand what I'm trying to say here? It's unnerving, to say the least. It's totally unnerving, to say the least. So my point is that you need to understand that while you do have a limit on your policy, your claims are more often than not being adjusted based on sublimits. So start to get into the weeds on the sublimits, start to understand those sublimits a heck of a lot more than you ever cared before. Start asking about sublimits. When I bring up this issue of sublimits to a lot of our, particularly multifamily property owners, it's unbelievable how some of them never even heard of the term or concept of it. Yet when I actually look at their loss runs, particularly those that have like B and C properties, and we start looking at the frequency of their claims and all the claims that they have, how many of them were subject to some sort of stringent or low sublimit. And then we look at the out-of-pocket expense, and then some of them are just basically just significantly value engineering what it is that they're doing just to only spend the money that they got and nothing more. But when you actually look at, they went from like ceramic tile to a laminate flooring. Like that's not even close, right? The insurance company, because they paid them 40% of the cost of ceramic tile, depreciated 60%, it's one of the instances, and then they don't want to even pay them any portion of the money back, but they were on notice almost immediately during the claim. There's actually an email between the adjuster and the insured's representative that they were having an issue getting tile for this property, and it just seems stupid. It just seems egregious, greedy, I'm glad that there's a lot of consumer reports coming out about this dissatisfaction. I'm just hoping that maybe at some point tides will change here. Things will get a little bit different, better for the consumer. Maybe federal, local, state governments will start getting more involved in it. If you saw in Florida, our governor wrote if you actually look at the notice calling the special session on insurance, it only talks about the homeowners property market. But if you actually look at the broad sweeping bills that were being passed, they impact commercial property owners, operators, community associations at large. But why? If the issue was allegedly, and that is a strong allegedly, because quite frankly, I think all, if not most of it is total bullshit, is misleading information, and only it literally meant to play to the special interest groups and the lobbyists for these insurance companies. We need consumers to speak up, speak out about what's going on, talk more about the things that are going on, particularly when insurance companies, and I picked on certain insurance companies here in this broadcast today that are largely insuring a lot of the properties that we're seeing, that we're handling claims for. And I think that this is important information that you as consumers need to be aware of. So we're going to continue broadcasting stuff, continue talking about it, make sure that you're aware of what's going on, what's actually happening, because you're probably not subscribed to the newsletters. You're probably not on these blogs. You're probably not engaged in discussions about these things and the realities of what is actually going on and how things are done in this industry. You're just, again, you're buying insurance because you're required to do it. You probably just want to write that check painfully and just not think about it again. You put it on automatic withdrawals with your broker, and again, you forget about it. You escrow it when you get your mortgage. You forget about it, right? You just don't want to think about it. But wise up to it. Start asking questions. Start looking at it. That's what this broadcast is all about here at GlobalPro. We've been doing the Recovery Report live for over a year now. Over 100 episodes talking about insurance information you can use. We're having on industry experts all the time. Today I wanted to hit on a hard-hitting issue about earnings, about profits, and about sublimits. And I hope this information was meaningful to you today. And if you found this meaningful, and if you haven't already yet, hit the subscribe button, like us, follow us on all our social media platforms. We want to make sure that you're getting the notifications when we go live here from the Griffin Studio. And we'll see you next week, same place, same time, right here on the Recovery Report Live.